Every week, someone tells you the future of cars belongs to a company that didn't exist a decade ago. Tesla, Rivian, Lucid. Billion-dollar valuations built on software promises and government subsidies. The financial media obsesses over them. The algorithms feed you their every quarterly miss like it's breaking news. And then there is Peugeot. No one talks about Peugeot. No pundit is breathlessly covering its software roadmap. No Silicon Valley investor is on a podcast explaining why it will disrupt transportation. It sits there in the background, selling millions of cars a year across 160 countries, quietly running the operational spine of one of the largest automotive empires on Earth. The businesses that survive the longest are rarely the ones that move fastest. They are the ones that bleed the slowest, learn the hardest lessons, and outlast everyone who underestimates them. Peugeot has survived 2 world wars, the Great Depression, a near bankruptcy that shocked France, and the most chaotic automotive upheaval in a century. It did not survive by being brilliant. It survived by being relentless. This is the story of how a 216-year-old French company turned a corporate death sentence into the 4th largest automotive group on the planet, and why the lesson it teaches is worth more than anything Silicon Valley will ever tell you about disruption. In 1810, 2 brothers in a tiny French town called Hérimoncourt converted their family's grain mill into a steel foundry. Jean-Pierre and Jean-Frédéric Peugeot had no plan to build cars. The automobile had not been invented yet. They made steel saw blades, then the tools, then coffee grinders, then corsets were reinforced with steel rods, then pepper mills. They were not chasing a vision. They were just extraordinarily good at making things out of metal. By 1882, Armand Peugeot, the founder's nephew, was building penny-farthing bicycles. By 1890, he was testing a steam-powered 3-wheeled vehicle with an engineer named Léon Serpollet at the Paris World's Fair. By 1896, Automobiles Peugeot was formally registered as its own company, making it, by most credible accounts, the oldest surviving car manufacturer in the world. Then came the 20th century with all of its violence, the First World War. The Great Depression, which hit French automakers hard, but Peugeot survived with the cheapest car on the French market, the 1929 Peugeot 201. The Second World War, which saw its factories occupied and bombed. When peace arrived, Peugeot came back with the 203, the first post-war model, selling over 500,000 units. In the 1970s, it absorbed a struggling Citroën. In 1978, it took over the failing European operations of Chrysler. By the time most of today's EV startups were a daydream in a pitch deck, Peugeot had already died 3 times and come back each time. If you want to understand what almost killed Peugeot, you have to understand what it felt like to run it in 2005. The family still controlled the company. Not just symbolically. The Peugeot family had seats at the table, votes in the boardroom, and a cultural authority that no outside executive could easily challenge. That kind of history creates a particular disease in large organizations. It breeds the quiet certainty that because you have always survived, you will always survive. PSA Peugeot Citroën, the group holding both brands, was producing cars across too many models on too many separate engineering platforms. Every new car cost a fortune to develop because there is almost no shared architecture between them. The factories were bloated. The organizational hierarchy was deep. Decision-making was slow, layered in French bureaucratic tradition, and insulated from the kind of market pressure that forces real change. Meanwhile, the world was shifting. Korean brands were winning on value. German brands were winning on prestige. The Chinese market was accelerating. PSA had exposure in China but no dominant position. It had global ambitions but a European mindset. By 2007, the share price had already begun to crack. By 2008, as the global financial crisis arrived, the bleeding started in earnest. The group burned through billions. It kept producing more cars than the market wanted, cutting prices to move volume and destroying its own margins in the process. The family watched, the family debated, and nobody did anything decisive. If you've been watching this channel, you already know this pattern. It shows up every time a legacy institution mistakes its past for a guarantee of its future. Subscribe now and stay with us, because what happens next is where this story really begins. By 2013, PSA Peugeot Citroën had accumulated losses of more than €7 billion over 2 years. That is not a rough patch. That is an existential crisis wearing a suit. The automotive division alone swung from a small operating profit in 2011 to a loss of €538 million in the first half of 2013. The company's break-even point, the minimum number of cars it needed to sell just to cover its costs, was 2.6 million vehicles per year. In a shrinking European market, that number was becoming impossible to hit. The panic in Paris was real. The Peugeot family, which had controlled the company for over 2 centuries, was forced to accept the humiliation of a bailout. By 2014, the restructuring was settled. The French government bought in at 14%. China's Dongfeng Motor bought in at another 14%. The founding family, which had once owned the whole thing, saw its stake reduced to 14% as well. 3 equal partners, none of them in full control, and a company hemorrhaging cash. 9,000 jobs had already been cut before 2014 even began. A factory had been shut. Wages were frozen, and still the numbers were not working. The board needed someone who understood pressure. Not a diplomat, not a consensus builder, not another insider from France's comfortable industrial establishment. They needed a surgeon who could cut without flinching and who actually wanted to come in and fix something most people had already written off. They found one. Carlos Tavares does not look like the person who saves companies. He is calm, precise, and almost eerily composed in every public appearance. Former French Finance Minister Bruno Le Maire once described him as a samurai, obsessed with work, demanding, cold, and possessed of tremendous efficiency. That description was not meant as criticism. Tavares had spent 30 years at Renault, rising to the number 2 position, before publicly telling journalists he wanted to run his own company. His boss, Carlos Ghosn, fired him the same week. Peugeot hired him almost immediately. He arrived at PSA in 2014, as the company teetered on the edge of something irreversible. He had started his career as a test driver. On weekends during his first year running PSA, he was still racing GP2 single-seaters on track. That background matters. Racing drivers are not interested in moral victories. They're interested in the next corner, the next lap, the next tenth of a second. His operating philosophy was simple and brutal. He called it a profit-driven culture. The company had to stop measuring itself by the number of cars it sold. It had to start measuring itself by whether those cars made money. He walked the plants, he met the dealers, he understood the machinery of the company before he began rewiring it. And then, in April 2014, he stood up and named his plan. He called it Back in the Race. It would hit every benchmark the industry said was impossible, and it would do it twice as fast as anyone expected. Most turnaround plans announced by struggling companies are sophisticated exercises in buying time. They promise a 2% margin by 2018, and hope the board doesn't notice when 2018 arrives, and the margin is 1.3%. Tavares was about to show the industry something entirely different. The plan Tavares announced in April 2014 had 3 core targets: recurring positive free cash flow by 2016, a cumulative €2 billion in free cash flow between 2016 and 2018, and a 2% operating margin in the automotive division by 2018, with a target of 5% in the next planning cycle. The industry read those numbers and raised its eyebrows. PSA had been losing money for 2 years. A 2% margin sounded like a fantasy. Tavares did not reach it by 2018. He reached it by 2016, 2 full years ahead of schedule. The mechanics were unglamorous and relentless. He trimmed the model range from the bloated sprawl it had become, targeting 26 models by 2020. He collapsed the number of manufacturing platforms from 7 down to 2, which meant that by 2018, PSA was producing an average of 1.9 million cars per platform per year, making it the most efficient volume manufacturer in Europe outside Volkswagen. The break-even point dropped from 2.6 million vehicles in 2014 to 1.6 million by 2016. 1 million fewer cars are needed to reach safety. He shifted the entire company's psychology from chasing volume to building pricing power. Instead of cutting prices to move units, PSA began reducing buyer incentives and letting the products earn their margins. The first half results for 2015 showed an operating profit of €1.4 billion on revenue of €28.9 billion. A year earlier, the automotive division was barely above zero. The plan that was supposed to take 4 years took 2. In March 2017, PSA Peugeot Citroën announced it was buying Opel and Vauxhall from General Motors for €1.3 billion. The reaction from the industry was somewhere between bewilderment and concern. Opel was not a turnaround opportunity, it was a graveyard. Under GM's ownership, Opel and Vauxhall had lost $20 billion since their last full-year profit in 1999, nearly 2 full decades of consecutive losses. Thousands of German workers are protected by some of the strongest labour agreements in Europe. A brand that had become so synonymous with mediocrity in the market that consumers had largely stopped associating it with anything worth paying a premium for. Serious analysts asked the obvious question. PSA had just finished climbing out of its own financial crater. Why would Tavares voluntarily absorb another one? The answer was a form of industrial logic that only makes sense when you understand what PSA had actually built during the back-in-the-race years. They had not just cut costs, they had built a replicable operating formula, a set of principles, disciplines and platform efficiencies that were, in theory, portable. Tavares believed the Opel problem was not structural, it was cultural and operational. GM had never forced the brand to earn its margins. PSA would. The price GM accepted, €1.3 billion for 2 brands with 40,000 employees, told you everything you needed to know about how desperate GM was to be rid of them. PSA had now placed a €1.3 billion bet on fixing a company that lost money for 20 consecutive years. Every major analyst on Wall Street and in Frankfurt was watching. What happened next was called, by J.P. Morgan, the quickest turnaround ever seen in the automotive industry. In the first 6 months of 2018, Opel and Vauxhall posted an operating profit of €502 million. Let that land. Under General Motors, the brands had not made a full-year profit since 1999. PSA bought them in March 2017. 18 months later, they were profitable. JP Morgan analyst Jose Asumendi wrote a research note that called it simply the fastest turnaround he had seen in the automotive industry in many years. Stellantis shares jumped 13% on the day the results were announced. How did PSA do what GM could not do in 20 years? The same way it fixed itself. Not with a dramatic new product strategy. Not with a brand reinvention campaign. With platform consolidation, cost discipline, and a refusal to use price incentives as a substitute for earning market respect. PSA agreed with German labour representatives to cut 3,700 jobs from Opel's German workforce of roughly 20,000. The development cost of new models was reduced by between 20 and 50% by moving Opel onto PSA's existing platforms. The next Corsa, the brand's core small car, would be built on shared PSA architecture at a fraction of what it would have cost under GM's fragmented engineering structure. Tavares had essentially photocopied the PSA playbook, walked it into Rüsselsheim, and told the organisation it would follow it precisely. It worked the first time it was applied elsewhere. In December 2019, PSA and Fiat Chrysler Automobiles announced they would merge to create one of the largest automotive groups in the world. The deal closed on January 16, 2021, and Stellantis was born. The combined group brought together 14 brands across Europe, North America, and Latin America. In unit terms, it was the 4th largest automaker on the planet. The transaction was structured as a merger of equals, with shareholders of both companies receiving shares in the new entity on equal terms. But here is what the press releases did not say clearly enough. Under IFRS 3 accounting rules, PSA was classified as the acquirer for financial reporting purposes. The legal shell might have been Fiat Chrysler's Dutch holding company, but Peugeot's DNA was the acquirer. Tavares became the CEO of Stellantis, not a Fiat executive. The operational discipline that had turned PSA from a near bankrupt also ran into a machine generating €8 billion of operating income was now being applied to a group with 14 brands and revenues approaching €150 billion. The Peugeot family, which had lost control of its own company in 2014, now found its operational philosophy running one of the most powerful industrial groups in the world. A French company that needed a Chinese partner and a government bailout to survive had merged with an American-Italian giant and come out holding the keys. In 2026, as Stellantis names Peugeot one of only 4 priority brands to receive a material increase in investment under its new Fast Lane 2030 plan, that fact carries a very specific weight. Silicon Valley will tell you the future belongs to the bold. Move fast, break things, disrupt the incumbents, capture the market before the old guard even understands what is happening. That story is compelling, and it sells conference tickets and it generates venture capital. It also has a very poor long-term survival rate. Peugeot was founded in 1810. The automobile company Peugeot was formally created in 1896, making it the oldest car company still actively selling vehicles today. In the 216 years since the Peugeot brothers converted a grain mill into a steel foundry, the company has survived the First World War, the Second World War, the Great Depression, the 1970s oil crisis, the 2008 financial crisis, and a near bankruptcy that shocked France into action. Every single one of its disruptors, the brands that were supposed to make it obsolete, is either gone, struggling, or quietly absorbing its lessons. The real insight of the Peugeot story is not the turnaround. Turnarounds happen. The real insight is the consistency of the underlying lesson across 2 centuries. Survive the current crisis. Do not add complexity. Earn your margins. Cut what is not working without sentiment. Build a foundation that can outlast the next disruption, whatever it turns out to be. Carlos Tavares left Stellantis under pressure at the end of 2024. The company he built faced its own new crisis, a €22 billion net loss in 2025, driven by write-downs on an overly aggressive EV bet. The wheel keeps turning. Stellantis is now in its own version of the back-in-the-race moment, with Peugeot explicitly named as one of its 4 core assets to bet on. The tortoise is still in the race. It has never once stopped running. If this story made you rethink what resilience actually looks like in business, share it with one person who needs to hear it. And if you want to go deeper on the companies that survive everything the market throws at them, the subscription button is right there. We will see you in the next one.